Something arrived through your door from HMRC, a tax bill, a number, an amount they say you owe. And right now, in August 2026, there is a question you should be asking before you pay a single penny of it. Is it right? Because the answer, for a very significant number of UK taxpayers receiving HMRC calculations right now, is no. And I do not mean that loosely. I mean it in the specific, documented, officially acknowledged sense that HMRC's own computation software for simple assessment is not programmed to the same parameters as self-assessment, meaning it can and does produce incorrect tax liabilities that are sent to real people who then pay them without question because they assumed HMRC must be correct. My name is Frank. Welcome back to HMRC Update. Today, I want to have a very direct conversation about what is actually happening with HMRC tax bills right now, the known errors in the system, the brand new legal obligation HMRC just introduced that changes what happens when a mistake is found on either side, the real scandal of tens of thousands of self-employed workers billed for a tax that was abolished over a year ago, and the exact steps to take if you believe the figure you have been sent is wrong. If you are not subscribed to HMRC Update, please do that now and hit the bell. This is a channel that covers what HMRC does not explain clearly, and today's subject is one where that gap between what HMRC sent you and what you actually owe could be worth real money. Subscribe. Let us get into it. I want to start with something that professional tax bodies raised formally with HMRC and that has never been given the public attention it deserves. HMRC's computation software for simple assessment is not programmed to the same parameters as for self-assessment, which can lead to incorrect tax liabilities showing due, both for and against the taxpayer. The Low Incomes Tax Reform Group raised these issues with HMRC directly, describing it as an urgent
problem and advising that any simple assessment calculation should be checked carefully. Let me explain what that means in practice. A simple assessment, the PA 302 letter that HMRC sends to people whose tax cannot be collected entirely through PAY, is generated automatically by HMRC systems using data received from banks, pension providers, employers, and the DWP. That automation is designed to make the process simpler than filing a full self-assessment return. But the software that generates the calculation operates on different parameters from the software used for self-assessment, meaning it does not apply all the same reliefs, allowances, and edge case rules that a full self-assessment return would apply. These letters can affect a range of UK taxpayers. A retired person may receive state pension and private pension income. If not enough tax has been collected through the private pension, HMRC may issue a bill. Someone with employment income and significant bank interest may also receive a direct demand if the interest creates extra tax that has not been collected through PAY. The practical result is this. A pensioner receiving a simple assessment letter who simply pays the figure without checking it may be paying a bill that is higher than what they actually owe because the software that generated it did not correctly apply the starting rate for savings, did not correctly split joint account interest, did not account for a relief the taxpayer was entitled to, or included income from an ISA that should never have been in the calculation at all. Whatever the number of taxpayers affected, the question is how many will be able to recognize and challenge such errors. The answer, based on how these letters are written and presented, is very few, because the letter arrives from HMRC, carries an official HMRC reference, states a specific figure, and gives a deadline. Most people who receive it assume that if HMRC calculated it, it must be correct. That
assumption is the problem. Now here is the development that makes this significantly more urgent in August 2026, because HMRC just changed the rules around what happens when a tax error is found, and this one cuts both ways. Draft legislation published by HMRC on the 13th of July introduces a new legal duty to correct errors in tax documents, together with a power for the department to issue what it calls a customer correction notice. The measure sits within the Finance Bill 2026 to 2027 and forms part of a wider plan to modernize how tax mistakes are put right. Under the proposal, a taxpayer who becomes aware of an inaccuracy that has led to a loss of tax must take reasonable steps to fix it, either by amending the return or by notifying HMRC. The obligation applies only while the error can still be corrected within existing statutory time limits, and it reaches individuals, businesses, and the advisors who file on their behalf. The plans are not yet law. The draft is open to technical consultation until the 7th of September 2026, and a start date has not been set. Here is what this means in plain English.
HMRC is moving toward a legal framework where knowing about a tax error and doing nothing about it is treated as a failure of compliance, not just an oversight. Currently, if you discover you underpaid tax from a previous year, you can correct it voluntarily, and the penalty treatment reflects that voluntary action. Under the proposed duty to correct, failing to act on a known error would carry more serious consequences, potentially treating inaction as deliberate noncompliance. The reason this matters right now, even though the legislation is not yet final, is twofold. First, if you are aware of an error in your tax affairs, an income source you did not declare, an overpayment that affects future years, a relief that was claimed incorrectly, the direction of travel is clearly towards stricter treatment of inaction. The sensible response is to act.
Now, under the current framework, rather than wait until the new duty is in force. Second, and critically, the duty to correct applies both ways. If HMRC has made an error in your tax bill that results in you paying more than you owe, and you become aware of it, the same framework that requires you to correct your own errors implicitly supports your right to challenge theirs. Drop a comment below if you have received a tax bill from HMRC recently and have not checked whether the figure is correct, because what I am about to cover next is the most concrete example of an HMRC error affecting tens of thousands of taxpayers, and it is still ongoing. HMRC accidentally billed workers for a tax that was abolished last year. Class 2 national insurance contributions were effectively scrapped for self-employed people in April 2024. However, workers have reported that HMRC is still adding the levy of £179.40 to their tax bill, despite now being exempt. Some have been told to pay twice this amount, £358.80. Experts described it as ridiculous that HMRC was getting self-employed NI calculations wrong when it was quick to fine workers for errors navigating the complex tax system. A source close to the error reports indicated the problem was very widespread and that the number of people affected could be in the tens of thousands. HMRC said it was working urgently to resolve the issue. The Association of Taxation Technicians reported its members had received one of 3 letters containing errors from HMRC. The first said the Class 2 NI tax sum had been amended to 0, which made the letter unnecessary. The second wrongly demanded £179.40 in tax. The third demanded twice that amount. The rule change that caused this error is straightforward. From the 2024 to 2025 tax year onwards, self-employed workers with profits above £6,725 receive a national insurance credit automatically, giving them state pension entitlement, without paying Class 2 contributions. Class 2 NI was
abolished as a payable charge, but HMRC's systems in processing self-assessment returns for the 2024 to 2025 tax year continued generating Class 2 charges for a significant number of self-employed workers who are legally exempt from paying them. If you are self-employed, filed your self-assessment return for 2024 to 2025, and received a bill that includes a Class 2 national insurance charge, either £179.40 or £358.80, that charge should not be there if your profits exceeded £6,725. Do not pay it. Contact HMRC on 0300 200 3300. Reference the Class 2 NI abolition from April 2024 and ask for the charge to be removed from your calculation. HMRC has acknowledged the error and is working to correct affected accounts. But the correction is not happening automatically in every case. Many people are still being presented with the wrong figure. Now here is the systematic framework for checking any HMRC bill, not just the Class 2 error, because the categories of mistake recur across thousands of assessments every year. HMRC systems automatically apply wrong tax codes when you have multiple jobs or pensions, when benefits in kind or expenses were not updated, when a previous employer did not close your PAYE record correctly, or when your personal allowance was not adjusted for recent income changes. Each of those situations can generate a bill or a tax code that is wrong, not because you did anything incorrectly, but because the data feeding HMRC's automated systems is incomplete or outdated. The starting point for checking any HMRC bill is your personal tax account at gov.uk. Log in and look at the income figures HMRC is using. Compare them against your actual records, your P60, your payslips, your bank interest statements, your pension provider's annual summary. The figures HMRC holds should match what actually happened. Where they do not, the discrepancy is usually the source of the wrong bill. Specifically, for a simple assessment letter, check these 5
things before paying or accepting the figure. First, has ISA interest been included? Interest earned inside a cash ISA is completely tax-free and should not be included in any tax calculation. Banks report ISA and non-ISA interest separately to HMRC, but errors in that reporting do occur. If your bank statement shows ISA interest and non-ISA interest as separate lines, compare those figures against what HMRC's calculation includes as savings income. Second, has joint account interest been correctly split? HMRC assumes joint accounts are held 50-50. If the money in a joint account is predominantly owned by one partner, and that partner's income is below the personal allowance while the other partner's is above it, the 50-50 split assumption overstates the tax-paying partner's interest income. You can declare an unequal split to HMRC using Form 17, but only for income from jointly owned property. For bank accounts held jointly, the actual beneficial ownership determines the correct split. Document the genuine position and raise it with HMRC within the 60-day challenge window. Third, does the income figure match the correct tax year? Banks sometimes report interest based on the calendar year, January to December, rather than the tax year, April to April. That timing difference can mean interest earned in January to March of one calendar year appears in a simple assessment for the wrong tax year. Compare the interest figure on the HMRC calculation against your bank's annual statement, checking both the period covered and the amount. Fourth, has the starting rate for savings been applied? If your non-savings income, state pension, private pension, wages, is below $17,570, you may be entitled to receive up to $5,000 of savings interest completely tax-free through the starting rate for savings band. HMRC's simple assessment software does not always correctly apply the starting rate for savings, which can result in a tax liability being shown on savings.
Interest that should be tax-free. If your total non-savings income is below £17,570, check whether the starting rate band has been applied to your savings interest before it was taxed. Fifth, has a benefit in kind from a previous employer been removed? If you changed jobs and your previous employer did not close your PAYE record promptly, a benefit in kind from a role you no longer hold may still be appearing in HMRC's records and being included in your tax calculation. Check the income sources listed in your personal tax account against your actual current employment situation. For the 2025 to 2026 tax year, HMRC has tightened rules on Scottish tax codes starting with S. If you are in Scotland, double-check for codes like S1257L to avoid crossover confusion. And with frozen thresholds until 2028, more people are edging into higher tax bands, making accurate codes vital. If any of those 5 checks reveals a discrepancy, the route to challenging it is clear. If the figures are incorrect, you should challenge the calculation rather than simply paying the bill. For a simple assessment letter, you have 60 days from the date on the letter to contact HMRC on 0300 200 3310 and raise the challenge formally. Provide the specific figure you believe is wrong, the correct figure you believe should be used, and the evidence supporting your position. Bank statements, P60s, ISA annual summaries. HMRC must review the challenge and respond. If the challenge is upheld, the bill is revised. If it is rejected and you still believe the figure is wrong, you can request a formal review and ultimately appeal to the first-tier tax tribunal. Statistics from HMRC's 2025 digital report show 85% of errors are fixed via the personal tax account, faster than phone queues. Before calling HMRC, check whether the correction can be initiated through your personal tax account at gov.uk. For tax code corrections and simple data discrepancies, the online route is both faster and generates a
written record of the change requested, which matters if the issue later requires escalation. If you discover you have been overpaying because of an incorrect tax code, bill, or assessment, and the correction means HMRC owes you money rather than the other way around, the refund claim process is the same as for any overpayment. Submit a written claim to HMRC explaining the overpayment and referencing overpayment relief. HMRC will assess your claim and issue a refund if verified. Refunds claimed directly through the personal tax account typically arrive within 5 to 21 working days. Keep records of all correspondence, all figures, and all evidence for at least 6 years. So here is the complete picture and what to do with it today. If you have received a simple assessment letter, a PA302, do not pay it automatically. Check the 5 points I covered: ISA interest, joint account split, correct tax year, starting rate for savings, and stale employer benefit in kind records. If anything looks wrong, call HMRC on 0300 200 3310 within 60 days of the letter date to raise a formal challenge. If you are self-employed and your self-assessment calculation includes a Class 2 national insurance charge of £179.40 or £358.80, and your profits exceeded £6,725 in 2024 to 2025, that charge should not be there.
Call HMRC on 0300 200 3300 and ask for it to be corrected. HMRC's new duty to correct legislation, currently in draft and open for consultation until the 7th of September 2026, means that knowing about a tax error and doing nothing is heading toward being treated as a compliance failure rather than a passive oversight. If you are aware of an error in your tax affairs, in either direction, the correct response is to act on it now under the current more lenient framework rather than after the new duty takes legal effect. Always keep records for at least 6 years in case HMRC requests further evidence, and check your personal tax account at gov.uk.
Regularly, 85% of errors are resolved faster through the personal tax account than through phone calls. HMRC systems are automated, wide-reaching, and increasingly powerful. They are also, as the evidence I have covered today makes clear, not infallible. A tax bill with HMRC's letterhead on it is a calculation based on data HMRC holds. That data is not always correct. That calculation is not always right. And the 60-day window to challenge it does not wait for you to decide whether to look into it. Share this with someone who has received a letter from HMRC recently and paid it without checking the figures. The money that was overpaid does not come back automatically, but a challenge raised within the right window can get it back. Subscribe to HMRC Update if you are not already here.